Let's talk about Tesla stock and what's happening with it. Is this the beginning of an incredible growth phase that will continue for a long time? Or is it just another trap, where Tesla will rise only to fall back again? To understand this, we need to dive deep into options, trading volumes, and derivatives. We'll analyze growth points and resistance levels to predict what to expect. We'll definitely review the market forecast to understand if Tesla will continue to grow, or if things aren't that simple. Let's begin. As a reminder, back in June, Tesla stock grew by 50%. After a brief consolidation, it dropped by 30%, essentially returning to its previous range. Then followed another period of consolidation with UPS and downs, and now Tesla stock is unexpectedly starting to rise again. Why do I say unexpectedly, and why does Tesla show strength? Because while all the markets were declining, Tesla continued to grow. This is certainly very interesting, and this is why I want to focus your attention on this stock. Let's go through things in order. September 3rd was a disastrous day for all markets. While the Nasdaq dropped nearly 4%, Tesla was the only one holding on until the very end. On that day, Tesla initially tried to grow, but was eventually pulled down by the broader market. After that, Tesla grew by 5%, even though the markets didn't recover significantly. The same thing is happening now. The markets are declining, but Tesla is up almost 7%. Yes, it has pulled back a little since then, but there is still significant strength in this stock. Let's take a look at volatility and what's happening there. It's the volatility that will help us better understand this stock. The volatility smile on near-term expiration dates shows movement both upward and downward, which is normal, as predicting short-term movements is difficult. However, on longer-term expiration dates, volatility is skewed toward the downside, favoring put options. What does this tell us? This suggests that put options are more expensive than call options, indicating that investors, traders, and even volatility are pricing in a higher potential for a downward move rather than an upward one. However, I want to point out that it's common for funds to buy stocks and hedge those positions by purchasing put options, which often leads to put options being more expensive than call options. This is a normal situation. Now, let's take a look at historical and implied volatility. Historical volatility, represented by the gray line, and implied volatility, represented by the white line, are currently around the same values. On one hand, this is good because, as I often say, volatility tends to revert to its historical values. For retail traders, this might not seem significant, but professional traders focus on trading volatility, not just the underlying stock itself. In some situations, trading volatility can be easier because it tends to return to its historical levels, which provides a certain level of predictability. At the moment, volatility is near its historical average, which is both good and bad. It's good because the volatility chart is healthy, but it's also bad because there's no major inefficiency to exploit. This makes trading less effective in terms of gaining an edge in the market. That's why I prefer to identify and capitalize on market inefficiencies. Let me briefly show you how to play volatility so you can better understand what I mean. Artificial intelligence can help us develop some strategies, and we see that different strategies carry varying probabilities of profit or loss. For instance, one strategy involves selling 2 put options with a strike price of $230 and buying 1 put option with a strike price of $235. The strategy is set for different expiration dates, selling a put for December and buying a put for January. This is an extremely interesting, though complicated, strategy. What makes it intriguing? First, it involves both selling and buying options. Second, it uses different strike prices. And third, it involves different expiration dates and different option volumes, selling 2 options while buying 1. It's a complex but promising strategy that requires active management. If you manage it well, you can potentially profit regardless of where the stock moves. That's the key. However, I wouldn't recommend trying this strategy without proper understanding, as I'm just demonstrating what's possible. Now let's examine volatility and trading volume, which are critical. Looking at the call options, there's a huge volume around the $230 level, and so far, Tesla hasn't broken above $230. Yes, we tried, but as we can see at the moment, Tesla stock is returning above $230. Someone might ask, what happened? And I'll tell you, my friends, there are no miracles here. It's all about trading volume math and the options and derivatives market. That's all. Nothing more. Again, I'm recording this video while the market hasn't closed yet. There are still 3.5 hours until the market closes, and I'm ready to predict the price. My friends, I'm ready to tell you right now where the stock won't end up. It will most likely close below $230. This is my forecast. And again, it's not an empty prediction. It's based on the derivatives and options markets because it's not in the market maker's interest to let the stock go further. That's the secret. Of course, I could be wrong, but think about it. You can build a strategy in such a way that the stock won't go above $230. Yes, we can give ourselves some margin, say $240, and that's it. We start selling call options. That's the secret. And we start playing based on this volume. Yes, of course, it can break through, but we have at least something to rely on. You see, some people draw lines of resistance and everything else, but I'm giving you something a little different. After this volume, the next wall we hit is $235. By the way, that's exactly the wall we bounced off, my friends. Look, $235. Tesla touched it precisely and bounced back. Someone might ask, why this level? I'll show you clearly, my friends, just showing you what's happening here. $235 is an impenetrable wall, then $240, and then $250. After that, we have nothing. So, what happens? If we overcome these volumes at some point, Tesla could start rising sharply like a beautiful jump of 50%. That's what the analysis is about, and that's the secret, my friends. That's exactly how I trade. Plus, I use the ratio of mathematical expectation, risk, and profit. And that's how I manage to make money, my friends. That's the secret of why it works. Let me remind you, we have options. When someone buys a call option, the market maker on the other side has to sell the call option. When selling the call option, the market maker faces unlimited risk, and they hedge this risk by buying stocks. They buy the stock according to a delta-neutral strategy. Yes, my friends, explaining this strategy in detail would take an hour, but I'm giving you the shortest, most concise explanation of how it works. So the higher the delta, the more stock the market maker needs to buy to hedge. The more stock they buy, the higher the stock price goes. The higher the stock price, the higher the delta. It's a vicious cycle that leads to a gamma squeeze. By the way, as we can see, Tesla is starting to fall below $230. So far, my prediction is playing out perfectly. And of course, the market maker would prefer to keep this stock below $230, and then they'll collect the entire premium. That's the point. Now let's look at the support levels. This is the options path. The support levels are at $225. So at the moment, $225 is a significant support level for this stock. After that, we have $220. For now, the situation is like this, my friends. I hope you understand the essence and how this works. Now let's look at the market forecast. What does the market predict for this company? Let's start with mid-October. As we can see, the market predicts this stock to be in the range of $215, $225, meaning there's a slight decline in the stock price by mid-October. Now let's look at the forecast for the end of the year, for December. Here, the market is predicting the stock to be between $205, $215, meaning the decline continues. What about mid-year, let's say June, and the market forecasts the price to be $180, $190, a significant drop? What's the point? I remind you that all information about volatility, options, derivatives, and all financial components is concentrated here, which is why the market builds such a bell-shaped curve for what might happen. I wouldn't recommend going against the market. Why go against the market when you can move with it? Again, we can look at many stocks, and many are indeed falling. This also fits my theory that at the end of this year or early next year, a recession might start that could deeply affect all stocks. This will likely happen after the elections, but again, it doesn't matter if it's before or after. The point is that something is approaching that will scare everyone. Again, this is just my opinion. You can disagree with it. I'm just analyzing the information that I see. Now let's also look at 3D volatility. This is where all the information is concentrated. This is what all professional traders pay attention to. Now let's look at a strategy. I always show an interesting strategy that's based on options, one that you can't do with regular stocks. The strategy looks like this, especially the profit profile. As we can see, if the stock rises to $270, we could make $33,000. If the stock falls to $180, we could make $48,000. My friends, as we can see, no matter where the stock goes, we continue to make money. This is the secret to success, my friends. Using derivatives, combined with smart strategies and mathematical expectations, results in profit. That's the secret, my friends. I remind you, I don't know how to predict stock movements. I don't know where the stock will go. My main goal is smart position management, as I've just shown you. The strategy looks like this, but I don't recommend opening it yourself because the strategy is really complex. It involves different strike prices, buying and selling options, and the strategy needs to be managed buying and selling options at the right moment. I'm not going to open this strategy myself. I'm only showing it for demonstration purposes. So I think I've given the most detailed analysis of Tesla. To summarize, if we break through all these levels, all these resistances in the near future, perhaps due to some news, then more serious upward movements open up. However, if we stall here and the market makers manage to halt the movement, then naturally Tesla stock could eventually fall back and continue to consolidate. If you have any questions, leave them in the comments and I'll try to answer them. Good luck to everyone.